In March of 2023, something impossible happened. Silicon Valley Bank, a $40 billion institution, the bank of the smartest tech founders in the world, died in 48 hours. We think of bank runs as history, old movies, Jimmy Stewart pleading with crowds in It's a Wonderful Life. But here is the truth that the financial influencers won't tell you. Modern technology has turned a slow panic into a lightning strike. And here is the scary part. You do not have to stand in line to lose everything anymore. You just have to sleep through a push notification. Today, we are breaking down the structural insanity of fractional reserve banking, why the FDIC's $250,000 promise is psychologically useless, and how you, right now, is 3 text messages away from a digital bank run. Let's start with the lie they taught you in high school. Part 2. The Fractional Reserve Trap. When you deposit $100 into Chase or Bank of America, where does it go? Most people think it goes into a big steel box with your name on it. It doesn't. Banks are not storage lockers. Banks receive deposits and disburse 90% of it as loans to generate revenue. Banks operate on a system called fractional reserve. This means if you deposit $1,000, the bank is legally allowed to lend out $900 of it immediately. They keep only $100 in the vault, what they call the reserve requirement. In theory, this is brilliant. That $900 loan was used to purchase a house. The house purchaser paid the contractor. The contractor deposits his $900 in another bank, and that bank lent out the $810 as loans. Suddenly, your $1,000 has turned into $10,000 in course of economic activity. But magic is just another word for high-wire acrobatics without a net. The moment you and your 9 neighbors all want your physical cash at the same time, the bank collapses. Not because the bank is bad, not because it committed fraud, but because nature prevents matter from being in 2 places at once. That $1,000 you deposited? It's currently manifesting as a roofing nail in a construction site in the next county. In 2007, Northern Rock in the UK was a perfectly solvent bank. They had billions in assets. But when panic hit, they only had 8% liquid cash. People camped outside for 3 days just to withdraw their salaries. Now, multiply that panic by the speed of the internet. Part 3. The digital, silent, run. Here's the difference between 1933 and 2026. In 1933, if you wanted to start a bank run, you had to put on your pants, drive a Ford Model T, stand in a line that wrapped around the block, and yell at a teller. You had time, the bank had time, the government had the weekend to close the doors and stop the bleeding. Today, a bank run happens while you are brushing your teeth. It is called a silent run, or a digital withdrawal run. In 2023, Silicon Valley Bank lost $42 billion in deposits. Not over a week, not over a weekend, in 10 hours' time, tech founders sat in group chats on WhatsApp and Slack. One person said, "Hey, is SVB okay?" A venture capitalist replied, "I don't know, but I just moved my $50 million to JP Morgan." 3 people saw that, they moved their money. 400 people saw those messages. They opened their mobile apps. No one waited for a statement from the CEO. By the time the CEO tweeted, "Everything is fine," the servers were already crashing from the traffic of withdrawal requests. Here is the structural vulnerability that keeps regulators up at night. Technology removes the friction of fear. When withdrawing money costs 0 effort, just a thumbprint, irrational fear becomes an irrational avalanche in milliseconds. Part 4. The $250,000 psychological flaw. Now, the smart people in the audience are shouting at their screens, but the FDIC. My money is insured up to $250,000. This guy is scaremongering. You are right, and you are wrong. Let me explain the concentrated uninsured deposits problem. The FDIC insures you, the individual, up to $250,000 per account. Great for a teacher, great for a plumber, but 80% of the money in the American banking system is not yours. It belongs to corporations. A tech startup with 400 employees has $15 million in the bank to make payroll. They are not insured for $14.75 million of that. If the bank fails, they lose everything above $250,000. Silicon Valley Bank failed specifically because 94% of its deposits were uninsured. When the founders woke up and realized their $10 million payroll was at risk, they didn't just run. They sprinted. Here is the cruel math of a modern bank run. Depositor A, you, has $5,000. Insured, should stay calm. Depositor B, CEO, has $5 million. Uninsured, must leave immediately, but when depositor B leaves, the bank loses liquidity. That causes the bank to sell assets at a loss. That causes the stock price to drop. That causes you, depositor A, to panic. And just like that, a rich person's rational risk management becomes your crisis. Part 5: Social media as a weapon of mass destruction. We have to talk about the megaphone. In 2008, information moved at the speed of cable news. In 2026, information moves at the speed of group chat. Let me read you a real tweet from March 10, 2023, at 6:32 a.m. I just tried to wire money out of SVB. Website is frozen. Did anyone know if they are insolvent? That tweet was viewed 2 million times in 90 minutes. There is a concept in behavioral finance called informational cascades. It means, when you see 10 people running toward an exit, they won't be stopping to check if there's a fire. But just run, because the cost of staying is death. The cost of leaving early is just inconvenience. Social media removes the signal and amplifies the noise. Worse, algorithms reward outrage. A newspaper headline that says major US bank on brink of collapse gets 10 times more noises than that which says clicks of banking system remains largely stable. So the algorithm creates a feedback loop of fear. This is why regulators are terrified of TikTok bank runs. We saw it during the Republic First Bank runs panic in 2024. A viral video with 500,000 views showed a glitch in the ATM. A glitch that had nothing to do with solvency. Within 3 hours, the bank had a 12% withdrawal rate. The financial system is now a meme stock. And memes do not care about balance sheets. Part 6: The Diamond Dybvig model. The academic proof. For the nerds in the room, this isn't a theory. It's a mathematical certainty. In 1983, economists Douglas Diamond and Philip Dybvig proved something terrifying. Even a healthy bank is unstable. They created a model with 3 types of people. 1. Patient depositors. Don't need cash now. Willing to wait. 2. Impatient depositors. Need cash now. Legitimate withdrawal. 3. Panicked depositors. Don't need cash, but fear others will take it first. Diamond and Dybvig proved that if a bank serves the impatient people first, the patient people are fine. But if the patient people think the impatient people are actually panicked people, the patient people will rush to withdraw too. The bank then fails not because of bad loans, not because of fraud, but because of a self-fulfilling prophecy. I think the bank will fail, so I withdraw. My withdrawal causes the bank to fail. I was right. This is the bank-run Nash equilibrium. It is a trap built into DNA of fractional reserve banking. And this is why modern safeguards, deposit insurance, the Fed's discount window, bailouts don't stop bank runs. They just slow them down long enough for the fire department to arrive. But if the fire spreads as fast as a text message, the fire department is always late. Part 7: The Asset Liability Mismatch, the hidden bomb. We have to get technical for 4 minutes. But this is the part the banks don't want you to understand. It's called duration risk. When you deposit money, you have a liability to the bank. They owe you cash on demand. That is short term, but what does the bank do with your money? They buy assets. Specifically, they buy 10 years long-term government bonds. That is, the bond will mature in 10 years for payment with the accrue interest. Treasuries and mortgage-backed securities, 30-year home loans. In a normal world, this is fine. The bank holds the bond until it matures in 2035. They get their money back. You get your interest. But in 2022, the Federal Reserve raised interest rates faster than ever before in history. Here's the rule of bonds. When interest rates go up, the price of old bonds goes down. Let me give you a concrete example. In 2021, a bank buys a 10-year US Treasury bond. It pays 1.5% interest. In 2023, the Fed raises rates to 5%. You can now buy a new bond paying 5%. Why would anyone buy that old, crappy 1.5% bond from the bank? They wouldn't, unless the bank sells it for a huge discount. Silicon Valley Bank had bought billions in safe 10-year bonds. When rates spiked, those bonds lost 20% of their market value. Now, here is the trap. On paper, SVB was still solvent. If they held the bonds until 2032, they would get every penny back. But a bank run forced them to sell early. They had to sell the $1,000 bond for $850 to give you your $100 bill. That $150 loss isn't abstract. That is destroyed capital. Do that a billion times, and the bank is bankrupt. That is the asset liability mismatch. Long-term assets funded by short-term liabilities. It is the original sin of banking, and no technology has fixed it. Part 8. Practical takeaway. So, what do you do with this information? You have heard me explain the 4 horsemen of the modern bank run. Sectional pie chart image of 1. Fractional reserves, the 10% trap. 2. Digital speed, the silent sprint. 3. Concentration, the uninsured whale. 4. Social panic, the viral rumor. Are we heading for a total collapse tomorrow? Probably not, but here are 3 structural defenses you should have today. Defense 1. The 2-bank system. Do not put all your operational cash in one bank. Keep your operating account, where you pay rent and buy coffee, in a large, too-big-to-fail bank like JP Morgan or Bank of America. Why? Because the government will bail them out. They are systemically important. The FDIC might take a weekend to save a regional bank. They will take an hour to save Chase. Defense 2. The sweep network. If you have more than $250,000 in cash, or if you run a business, you need a bank that uses deposit sweeps. This is a loophole. The bank automatically sweeps your money into different FDIC-insured accounts at different partner banks. Legally, you end up with $1.25 million in coverage. If your bank doesn't offer this, switch banks tomorrow. Defense 3. Physical cash. Yes, really, in a digital silent run, the ATM limits drop to $500 per day. Wire transfers get delayed by 48 hours. You don't need a bunker full of gold bars, but you need 2 weeks of operating expenses in physical cash in a fireproof safe. When the servers crash, the card stops working. Hard currency is the only asset that doesn't have a server error message. Part 9. Conclusion. There is an old saying in finance: the bank is fine until it isn't. We have built a global economy on a foundation of trust. But trust is a feeling, and feelings are volatile. Modern technology has not fixed the bank run problem. It has just changed the weapon. Instead of running down Main Street with a pitchfork, we run with a smartphone. The banks are safer than they were in 1933. But they are faster to fail than ever before. SVB 42 billion. In 10 hours. Don't panic. Don't withdraw all your money tomorrow. That would cause the exact thing I'm warning you about. But be aware. Understand that your safe $250,000 is a psychological tether, not a physical reality. Understand that the bank's balance sheet is a snapshot of yesterday, but the withdrawal is happening now. The system works. Until the group chat wakes up, hit subscribe to get access to more educative videos as soon as they are released. Thanks for watching. See you in the next video.